Chris Irvin, a 14-year trading veteran of options, stocks, futures, and currency markets, is a real-world trader who's determined to help others find their place in the investment world. After owning a successful computer training company for 6 years, he found that the dream of owning his own business rarely involved a good night's sleep. He needed a change. In an effort to find a self-reliant form of income, Chris began trading options in 2000. With his very first trade, he knew that trading was not only the way for him to generate an income, but a way to control his time and spend more of it with his family. After years of going through the school of hard knocks and being left disappointed in the mirage that so many successful traders put up, he set out to not only dominate the investment world, but to also help others find the truth about how they could reach their trading goals. As an international investment instructor since 2004, he has been a go-to contributor and speaker on Traders Television, Trading Views, and INO.com. His ability to trade and teach others garnered him national attention as an all-star by Trade King in 2011. All in all, trading is a form of opportunity and freedom in Chris's eyes. Trading is a way to be more than just your own boss. It's a way to be self-reliant, which equals true freedom. So I now turn it over to our next presenter, Chris Irvin. Chris, are you here with us?
I am here with us. How are you doing, James?
I'm doing well. Well, everybody, I turn it over to Chris.
Hey, everybody. Welcome. I am so grateful to be here today. I hope you guys have had a great day listening to all these fantastic speakers. I just want to let you know that I have spent the last 14 years trading the markets, and the thing that I really love the most about the markets is figuring out how to make money in the markets without picking a direction. I know that there's a lot of things that can be learned about options, a lot of intricate details about all sorts of the Greeks and Black-Scholes models and things like that. But I tell you, the thing that excites me most about trading options is the fact that you can actually kind of cut through all that stuff, get right to the point, and start making some money. So that's what we're going to try to talk about today. Again, my name is Chris Irvin. I am the Director of Options Education here at Market Traders Institute and the creator of the Ultimate Options course. I have spent some time teaching and training around the world. I actually, when I first started, just to give you a little insight into me, I started out as a youth pastor. I loved working with kids. I loved teaching. I loved everything about that job except for one thing. The fact was that you didn't make very much money. And I didn't need to make a lot of money, but when my wife and I decided to start a family, I realized that I needed to make some more. And what I ended up doing was trying a variety of different things. I went to work for other people, and I found out I'm not a very good employee. I started my own computer training company, as James mentioned, and I found out that I don't like dealing with employees so much either. So my quest was actually to find an opportunity that would give me the time and the ability to spend time with my family and not have to worry about being an employee or being an employer. And I found out about options trading. That's where I got started. I've traded pretty much everything, but options are my first love. And I was really fortunate because when I started trading options, it kind of hooked me. You know, they say you get bit by the golf bug. I got bit by the options bug, and I just loved doing it. And I was also really fortunate because a couple years into my my trading experience, some folks gave me an opportunity to teach some classes, and that allowed me to actually start teaching classes all around the country in the United States. I've taught in pretty much every major city in the United States. I've been to Calgary, I've been to Vancouver, I've been to Toronto, I've been to Australia, 4 cities in Australia, and it's really opened up a great opportunity for me to spend time with people, just sharing what I know about options and helping them to become more successful traders. So I've been an instructor and a contributor to many financial news programs. I've been a blog writer and contributor to a lot of financial websites like INO, and I was named a Trade King All-Star in 2011. So I really enjoy options. I really enjoy teaching people, and I think the thing that people like most about my class, again, is that I try to take complicated issues and make them as easily understood as possible. So hopefully that's what you're in for today, and that you will benefit from that. Now, let me just share a little bit about Market Traders Institute. the company that I work for. I came to them about a year ago, and it was at a time where market traders was focusing mostly on currencies, but they wanted to get started with options trading because they knew how powerful it could be. So they asked me to write an options course for them, and that's where the Ultimate Options course came into being. Over 100 employees located here in beautiful Lake Mary, Florida. Been in business for over 20 years. This is a solid company, and I can't say enough about the folks and the staff here at Market Traders Institute. They know what they're doing, and they're here to support you every step of the way. So with that said, you know a little bit about me. Now, I need to know a little bit about you. So what I've been doing here is I've actually been looking, every place that I go, I actually look for people who caused some certain things. For instance, I want to know if you're the one who actually took this great looking chart of Tesla and got into a trade and caused this to happen. Were you really ultimately responsible for this? You know who you are. You're the person that gets into the trade, and as soon as you get into the trade, it goes the opposite direction. I know. You know who you are. Or maybe this one. This is Chipotle, okay? They make big burritos, and their stock is really expensive because they make big burritos. Now, you tell me, are you the one that took this stock short and caused it to do that? Now, you know what? I know that you're out there, the person that did this. And if you're not responsible for this trade necessarily, I know that there's others that you feel like you're responsible for. Are you the person that said, I think I'm going to buy some Netflix. Oh, but maybe I should wait just a few more days and watch it. And you caused that to happen? You know who you are, right? You're sitting there thinking, yep, that happened to me. That happened to me every time. So the question is, do you ever feel like somebody's watching you? While you're sitting there at your computer doing the best you can at trading, do you ever feel like somebody's just sitting there watching you, and every time you make a move, they go the other direction in the market? Sometimes do you feel like when you try to click the mouse button, you have to click it and jump back because you're afraid of what's going to happen? I know you're out there. I know there's tons of people that have this very issue. Are you directionally challenged? Do you have problems picking the right direction in the market? Are you the most indecisive person that you know when it comes to trading? Here's your answers. Yes, no, or maybe. See what I did there, right? You know what? If this describes you, if these types of things happen to you in the market, I think you're going to enjoy this presentation because it's about how to make money in the market without picking a direction. You know what? In this presentation, you could be the worst stock picker in the entire world. You could be directionally challenged. You could be totally indecisive about things. But the strategy that I'm going to share with you is a strategy that allows you to set an appointment and get into a trade. Okay? You know when the event is going to come up that's going to drive the trade. There's no hesitation. You know when to get in, and you place the trade. And you're waiting for the event to happen that's going to cause the stock to move, and you know when it's coming. Guys, this is called a straddle. There's all sorts of different conversations about straddles out there, weekly straddles and monthly straddles. I'm going to concentrate on earnings straddles. You see, a straddle is an option strategy that allows a trader to take advantage of a known event with an unknown outcome. And that's what I really appreciate. Because I don't like guessing. I don't like sitting in front of the computer all the time. I just like knowing that there's a date on the calendar that says to me, I have an opportunity right now to get into a trade. I could stay in it for a day, overnight. Sometimes my profit shows up. It might take me a week, something like that. I put the trade on. I know when exactly it's coming, and I don't have to guess about entry points. That's the type of trading that I like, and that's what earnings season does for me. You see, the first question that we have to answer right now is how many of the people in the room actually have any idea what equity options are? Now, I know that some of the folks that came before me were talking about options, so you probably do have some idea, but I'm curious how many people have really never traded options up to this point? Yep. Yep, I see quite a few. Fantastic. Okay, well, I tell you what, everybody that's in here that has never traded options before, don't worry. because I'm going to start at the beginning. Okay, you got to start at the basics to get where we want to go. You guys that have spent a lot of time trading options, hang in there with me for just a little bit, and we'll get to what you need as well. Because my objective here is to try to help you guys, everybody, to take something away from this presentation so that you can chew on it and you'll have something to work with at the end. All right, fair enough? Fantastic, I appreciate it. Okay, here's what you need to know. Again, basics. There are really two different kinds of options, and that's it. All right? There are call options, and a call option is the right to buy a stock at a specific price on or before a specific date. You see, a call option is not buying stock, it's buying the right to buy stock. So clearly that's going to be cheaper than what it would cost to actually buy stock. So that's one of the great things we love about trading options, the leverage. I'll explain more about that in just a second. But the other type of option that we have, remember there's only two types. The first one is a call option, the second one is called a put option. Now the put option is the right to sell a stock at a specific price on or before a specific date. That's really it. There are calls and there are puts, and that's what it comes down to. Now there's all sorts of fantastic things you can do with calls and puts, but let me expand on just those two for just a second. Here's what you need to understand about a call option. A call option, if you think a stock is going to head up in value, you would use a call option, which means you would buy a call option to make money in the market. Okay, the call option is the interest instrument that helps you to make money as a stock moves up. And on the other side of the equation, if a stock is heading down, or if that's what you believe it's going to do, you can buy a put option and make money with the put option as the stock is moving down. So here's what you need to understand about that. If that's difficult for you to remember which is which, calls and puts, when we think about a phone, most of the time when we call someone up, we say, I think I'm going to call that person up. Okay, so we can remember calls go up. This is just a little trigger in your head to help you remember which way calls and puts go. So when we call someone, we call them up. So calls go up. And when we're done with the conversation, typically what do? We put the phone down. So we call somebody up, we put the phone down. That's how you can remember which direction they go, because calls go up and puts go down. Hopefully that's helpful to you. It was helpful to me when I first started out. Now, you got the basics of calls and puts. The question is, why do we actually want to trade options? And the answer to that is leverage. All right? Here's just one example of thousands of examples that are out there. There are somewhere between, well, right around 40,000 publicly traded companies traded right now. But of those 40,000 publicly traded companies, there's somewhere between 2,500 and 3,000 that we have the opportunity to trade options on. IBM is one of those companies. All right? We've got some big-time companies that trade for big-time dollars. For instance, IBM, when I took the screenshot, was trading for $172.88. Now, that's fairly expensive for a lot of folks. But the call option at the same time was trading for $5.50, far more affordable. And again, this is why we want to trade options, because we're not buying the stock, we're buying the right to buy the stock for much less, pennies on the dollar. All right, so this is how an option works, okay? We're talking about a call option right now. If the underlying stock increases in value, let's say we have a stock that's trading for $20, and we've got an option associated with that stock that's trading for $3. The amount that we actually pay to buy that option is called a premium. All right, so that's why it says option premium $3 there. Now, let's say the underlying stock increases in value. Well, if we own a call option, guess what's going to happen to our call option premium? It's going to increase as well. So as the underlying stock increases in value, the value of my option is going to increase as well. So that is how a call option moves. Now, a put option is a little bit different, and sometimes people have difficulty wrapping their heads around this. But a put option works like this. Say we've got the same $20 stock, but this time we don't think it's going to go up, we think it's going to go down. Well, $20 stock, $3 option. This time it's a put option. Let's say that the stock does decrease in value. What happens to my option? It doesn't decrease, it increases in value. So a call option increases in value as the underlying stock increases in value. A put option, as the underlying stock decreases in value, the put option increases in value. So they go the opposite directions. So if you buy a call option, you have the ability to make money as the stock's going up. If you buy a put option, you have the ability to make money as the stock's moving down. So between calls and puts, you can take advantage of the market, whether it's going up or going down. So those are two great opportunities. Now, here's the question. When I look at a chart like this of Facebook, the question that I have is Facebook headed up or down at this point? Now, I could do all sorts of technical analysis, and I do some of that to tell you the truth. But I would rather approach Facebook from a perspective of saying, I know that there's an event that's coming up that's going to drive Facebook one direction or the other. I don't even care which direction it goes. I don't know which direction. I don't have a crystal ball. I'm not going to be able to figure this out because I'm telling you there were time after time after time where I knew exactly what was going to happen to a stock's value. And sure enough, the earnings announcement came out. And what happened? Great earnings, fantastic earnings. Everything was great about that earnings announcement. And all of a sudden, the value of the stock fell. I didn't get it. Sometimes the earnings were terrible. And what happens? Stock price shoots straight up. It doesn't make any sense to me. All right? It doesn't make any sense the direction that the stock goes. But with options, we actually have the ability to make money regardless of which direction it goes. It just has to go. So in this case, I approach Facebook. Rather than trying to figure out how much it's going to increase or how much it's going to decrease, what I do is I write a straddle. I buy a straddle. Okay? I buy a straddle. Now, if I buy a straddle, okay, this is the strategy we're dealing with. Buying a straddle is buying a call option and buying a put option on the same stock at the same time. Now, if I buy a call option and buy a put option at the same time, all I have to do is sit back and wait and see what the announcement that I'm trading around, in this case maybe an earnings announcement, I just have to wait and see what the day brings from that announcement. In this case, on Facebook, what happened was Facebook the next morning opened up 20% higher overnight. It was up $11 on a $50 stock. Not bad. Now here's what happens. The call option increases in value, and the put option, it decreases in value, just like you'd think. Now, this strategy would not work if you were buying stock and shorting stock because it would be a one-for-one move and you'd never get in a winning position. But because of the way that options move, you have the opportunity to buy a call and buy a put. And as you get into the trade and the trade goes up, then your call option increases in value and your put option decreases in value, but the call option starts to make money faster and faster and faster the more it goes in your favor. And the put option actually starts to decrease its loss. It starts losing less the further away it gets from where you entered into the position. It's kind of an interesting phenomenon. As a matter of fact, here's how this trade worked out. I want to show you. This was Facebook, and you can see that I actually bought the call and bought the put. All right, I bought it on January 29th. And when I bought it, the call option was $4.95, and the put option was $3.70. Now, on January 31st, 2 days later, I sold them both back to the market. Okay? And when I sold it, you can see that my call option was now worth $10.90, and my put option was only worth 46 cents. So my put option got crushed, but my call option went huge. So what did that work out to be? That was a $225 profit, 26% rate of return in 2 days. You know, it's not a crazy rate of return, but I don't need crazy. I need consistent. And if that's who you are, then this strategy probably makes sense for you. Now, let me explain exactly how a straddle works and why. All right? Now, the way a straddle works is that it's a strategy that allows a trader to take advantage of a known event with an unknown outcome. So like I said, earnings announcements, they're excellent opportunities to trade straddles. Now, prior to the announcement, you're going to purchase equal numbers of calls and puts to create a delta neutral position. Now, I don't know if delta neutral is a term that you're familiar with, but let me explain what delta neutral actually means, because this is the foundation of a straddle trade. Now, before we figure out exactly what delta neutral is, we really need to understand what the delta is and how it works before we can figure out how to make it neutral. You see, the delta is the Greek letter used to describe the change in a derivative in both science and mathematics. And delta is the first letter in the Greek word diaphora, which means difference. So the delta, the real definition that we're going to use when we're talking about options, is that the delta is the rate of change in the options premium based on a $1 change in the value of the underlying stock. And for an example, I'm just going to consider that we're going to look at a January $50 call option on XYZ stock. So here's how the delta works. Let's say that I have that same $20 stock that we were talking about before. And I have the same option, the call option, that has a $3 premium. Well, every option is going to have a delta associated with it. And if in this case we have a delta of 0.50, that means I'm looking at a 50% rate of change. So to break it down, it works like this. If the underlying stock increases in value by $1, that means that my options premium is going to increase in value by 50 cents, because I'm going to make half of the value of the underlying stock's move, 50%. If I have an option with a delta of 0.25, then if the underlying stock increases in value by $1, my options premium is going to increase by $3. Excuse me, by 25 cents. It goes from $3 to $3.25. Now, if I have an option with a delta of 0.80, and these are the fat ones, if the underlying stock increases in value by $1, then my options premium is going to increase by 80 cents, which means it's going to be worth $3.80 total. That's what you really like, when those option deltas start to really cook and you get way up there. Now, so here's an example of a delta. Except now we're going to talk about the delta from the example of a put. Okay? Now, the delta of a put option is a negative number. This is something we need to keep in mind. The reason it's a negative number is that put options have an inverse correlation with the stock that they're dealing with. Okay? This means that the value of the option will move in the opposite direction of the underlying stock. So if the option has a negative 50 delta, then the underlying stock value decreases by $1. The option value will increase by 50 cents. Stock value decreases, option value increases. So again, let's look at that January $50 put option this time on XYZ. So here I've got a negative 50 delta. All right, that's a negative 50 rate of change. So here's my stock. My stock's at 20 bucks. I think it's headed down. Here's my option. That's a put option now, and it's worth $3. Now, if the underlying stock decreases in value by $1 and I have a negative 50 delta, then that means that I am going to make 50 cents on my put option. It's going to be worth $3.50 now, because if I've got a put, there's a negative correlation to the rate of change. So if there's a decrease in the value of the stock, my option is going to increase by the delta. Okay? Now, the next thing that I'll point out to you is if you have a delta that's much lower, a 0.25, a negative 0.25 delta, then my options premium is going to increase by 25 cents if the underlying stock falls $1. And if I have a negative 80 delta and the underlying stock decreases in value by $1, then my options premium, it's going to increase by 80 cents. So this is the way the delta works. I really appreciate the delta because this way I know how much I'm going to make in an option strategy when I get into it. Now, here's another thing to know. Market makers have a tendency to use the delta a little bit differently than we do. When we look at the delta from a trader's perspective, we look at the delta from the perspective of saying, how much is my option going to move based on a $1 movement of the underlying stock? Great. But for a market maker, the delta signifies the percentage chance that the stock will close beyond the strike price at expiration. So this concept is going to help the market maker to manage their risk. And that's how they use the delta. So again, another example, January $50 call option. So if the call option is an at-the-money call option, meaning the strike price is at or near the stock price, the delta will be at or near 50. All right, so if I have a stock price that's trading at $50 and I buy a strike price, an option with a strike price of $50, remember I told you at the very beginning we were talking about the definition of an option. An option is the right to buy a stock at a predefined price on or before a specific date. Well, that predefined price is called the strike price. All right, so in this case, I'm buying the right to buy the stock at the same price it's trading for currently. And that's considered an at-the-money option, the option with the same strike price as the stock price. Now, from the market maker's perspective, and this is going to make total sense to you, in that case, there is a 50-50 chance that the stock will close beyond the strike price at expiration. Because I'm looking out in the future, maybe I buy an option that has a month or 2 months worth of time in it. Because the stock price and the strike price are the same, the market maker looks at this and says, it's a coin toss. It could go either way, right? So we've got a 50-50 chance. That's how the market maker looks at the delta of 50. Now, there's another type of option, actually two more, and if the call option is an in-the-money option, which means that the stock price is beyond the strike price, the delta is going to be greater than 50. So again, let's think about this from the market maker's perspective, and you all know who the market maker is. The market maker is the person that stands in the middle of the trade. There are people buying and selling options all day long. The market maker is the person that stands in the middle. They're the Walmart of selling options. Okay? If you go to Walmart, people buy shirts from Walmart, but there's also people that manufacture shirts and they sell them to Walmart. So Walmart's got people coming at them from both directions, the buying side and the selling side, the buying side and the selling side. The market maker's got the same thing going on. They have people that buy options and people that sell options, and they are the middleman that stands in the middle of the trade. All right, with that in mind, if a market maker looks at an option and says, okay, the strike price is at 50, but the stock's already at 65. If I buy that option and I have the right to buy it at 50 bucks, but it's already trading 15 bucks above that, what are the chances that in another month or two that that stock price is going to close at or above that strike price? Well, probably pretty good. Pretty good, because if you think about it, it's already above the strike price. And that's considered to be an in-the-money option. Now, an in-the-money option, a market maker is going to say, you know what, that delta, because there's a much better chance it's going to close above the strike price at expiration, that delta is going to be way above a 50. Okay? It might be a 60 or 70. It might be an 80. Could be a 90. As a matter of fact, deltas can go all the way up to 1. It's rare. But the closer you get to 1, the closer you get to a dollar-for-dollar move with a stock. And that's kind of the happy place, at least for me. Because if I get into a trade and I realize that I could have spent, say, $178 on IBM stock and make $1, or I got into an option trade on IBM for $5.50, and if the underlying stock increases $1, I make $1, man, who's the smart one then? It's the option trader. All right, so that's not always going to happen. You're not always going to have a dollar-for-dollar move. I'll explain how that moves in just a minute. But know this right now, that if the stock price is already above the strike price, then the market maker says we're going to have a delta that's far greater than 50, because it's more than a 50-50 chance it's going to close above that strike price by expiration. Now, the third type of option, so we had at the money, we had in the money. Now we've got what's called out of the money options. And out of the money options are those that have strike prices that are above the current stock price. This is a call option. So we think the stock is going to go up. We buy a strike price at 50, but the underlying stock hasn't even gotten to 50 yet. It's still at 45. It's got to work its way up. All right? That's an out of the money option. All right? There's no telling where that thing's going to end up, but for right now, when the market maker looks at an out of the money option, they can't give it a 50-50 coin toss because it's below the strike price. Okay? So at this point, when they look at that particular setup with that option, they're going to say that there's a less than 50-50 chance that that stock is going to close above that strike price at expiration, at least at this point. So this is where we sit in an out-of-the-money option. Now, here's the thing. We can also look at that same kind of concept when it comes to a put option, except everything gets turned upside down. We still have in the money, at the money, and out of the money puts. All right? And when we have an at the money put, that just means that we're buying the same strike price as where the stock is currently, just like we talked about before. And again, from the market maker's perspective, if we have a strike price and a stock price that are at the same price, then there's a 50-50 chance that the stock's going to close beyond the strike price at expiration. If we have an in-the-money option, now that means that the stock price is beyond or has fallen below the strike price, and the delta is going to be greater than the negative 0.50. It's going to be in the 0.60, 0.70, 0.80 range. And because the stock price is already beyond the strike price, there's a better than 50-50 chance that the stock will close beyond the strike price at expiration. It just stands to reason. It all makes sense. So the last type of option that we have is the out-of-the-money option when we're talking about puts, and that means that the stock price is above the strike price, and the delta is going to be less than a negative 0.50. So remember, with a put, we're anticipating the stock's going to decrease in value, and as it's decreasing in value, but it hasn't gotten to that strike price yet, say we got a $50 strike, and we've got a stock price that's trading above that strike price at 55, hasn't fallen down to the strike price yet, the market maker is going to look at that and say there's a less than 50-50 chance that that stock's going to close beyond that strike price at expiration. So that's considered an out-of-the-money option. So why do I go through all this with you? Why do we talk about in the money, at the money, out of the money? Well, the reason is that the market maker doesn't like risk. And ultimately, the market maker would like to be in a position where he or she is in a neutral position. Remember, we started this conversation talking about delta neutral. So when a market maker is in a delta neutral position, that means they're neither long nor short the market. So the market maker is going to use the delta to determine if he or she is at risk on one side of the market or the other. So let's say that a market maker was selling options to somebody that was buying them, and or buying options from somebody that was selling them. And let's say that market maker has 10 call options, and those options all had a delta of 80, 0.80. Well, 10 times 80 is 8. Okay, so they're 8 long in this case. I'm making this very simple. Let's say they also have 20 call options with a delta of 40. So you do that multiplication and you see again, you're long 8. So a total long 16. And then what they do is they go 15 put options with a negative 15 delta, and they have, that makes, if you do that math, 11.25 short. Well, if you take the long and the short against each other, they're a net 4.75 long. That is not a delta neutral position. A market maker is going to work all day to try to get into a delta neutral position. Sometimes they'll do it with options against options. Sometimes they'll do it with stock against options. Well, this kind of delta neutral concept is where we're headed as well. You see, what we want to do when we buy our straddle is that we want to purchase equal numbers of at-the-money calls that has a 50 delta and equal numbers of at-the-money puts, which is a negative 0.5 delta. You see, if we take positive 0.5 and negative 0.5 and add them together, we come up with 0. And that is delta neutral. So a straddle is a delta neutral strategy that you put on. That means that when you get into the trade, you're walking the fence. You're not hedging one direction or the other. You're not thinking the stock's going to move up at this big announcement. You're not thinking the stock's going to move down at this announcement. You've positioned yourself in a place where you are right on the fence, delta neutral. Well, when the announcement's made, one option is going to increase in value and the other one's going to decrease. Well, that makes sense, right? And the profit is made when the winning option increases at a rate that is faster than the one that decreases in value. That probably makes sense, right? Well, as we move on here, I think we need to understand a little bit about how the delta actually moves back and forth. Because like I mentioned before, if you try to do a straddle with stock or with currencies, you got a problem. Because they all move one-to-one. Whether you go long stock or short stock, you've got a delta that is 1 on the long stock and -1 on the short stock. And those deltas never change. But when we're talking about a straddle with options, it's very different. Here's what I mean. The delta in an option is not a static number. It's the value of as the value of the stock increases and decreases, the delta is going to increase and decrease as well. So for example, we've got that same $50 call option we were talking about, all right? And we buy the $50 call option, that's a $50 strike, that's the right to buy the stock at $50. But when we get into that trade, the stock is not at $50. The stock is at $30. Well, the hypothetical delta that goes along with that might be a 10, a 0.10. That really tells me that I'm only going to make 10 cents for every dollar move of the underlying stock. So it's not a big move, clearly. All right? Well, let's say that the stock starts to increase in value. Remember, I got the $50 call option. Now, this is going to be considered an out-of-the-money strategy, okay, or an out-of-the-money trade at this point. Now, if the stock increases in value to $35, the delta doesn't remain a 10. The delta actually moves. It changes. It increases as the stock moves in your favor. So you don't make 10 cents for every $1 movement of the underlying stock. At this point, you're going to make 20 cents for every $1 movement of the underlying stock. If the stock moves up to 40, then the delta increases again, and maybe you're looking at a 30 delta. So 30 cents now for every dollar. It's getting better. If the stock moves to 45, our delta is possibly at 40.40. That means we're making 40 cents on each dollar move of the underlying stock. If we get to 50 bucks, remember we referred to that as an at-the-money option when we have strike price and stock price at the same time? Well, one thing I'll always tell you is that I know for certain that if you buy an option that has a strike price and a stock price in line with one another, it's going to be the at-the-money option, and your delta is going to be right near 50. If it's not dead on 50, it's going to be very close. 48, 49, 50, 51, 52, somewhere in there. It's going to be very close. 50 is your delta. You're going to make 50 cents for every dollar movement of the underlying stock. Now, if the stock continues to move on now, and the stock moves up to $55, now you're in the money. You're making money in this thing. Now, as it moves up, hey, guess what? Our delta increased as well. It moved up to 60. Now we're making 60 cents on every dollar. Now we're making 70. Now we're making 80. Now we're making 90. And that's the way the delta works. The more you're right in your trade, the more you're rewarded by the delta. It increases. And guess what? If you're wrong, it goes backwards too. So you start losing money slower. But let's go forward again. Now, let me show you how this works on a put option real quick. We got the same scenario with a put option, except we're expecting the stock price to move down, right? So we start out here with a $70 stock, but we think it's moving down, and we buy the $50 put option. Well, let's say that right now, because the stock's at 70, the delta is at -10, which means, again, we're only going to make 10 cents on every dollar move of the underlying stock. Again, this is an out-of-the-money option because the delta is so small. Well, if it drops down to 65 and starts to get closer to that $50 mark, I start to make some more money. Now I'm making 20 cents on every dollar movement of the underlying stock. Now, if we move down to 60, we're only $10 off our strike price for our call or our put option. Then our delta increases again, and now we're making 30 cents. Now we're making 40 cents. Now we're making 50 cents. Don't worry about the negative. That's not that we're losing that amount of money. It just means there's a negative correlation. So we're still making. When we get to the at-the-money strike price, we are making 50 cents for every dollar move of the underlying stock at the money. It's a 50-50 shot, right? As the stock continues to fall with a put option, the delta, again, continues to increase. So as the stock price falls, delta increases. And again, if it goes against you, same thing. You start losing money slower. Now, I think this is a pretty cool deal. But here's what I really want to show you. When we're talking about the delta, check this out. What if I buy a call option and a put option at the same time? All right? Let's say the one up top, that's the call option. The one on the bottom, that's the put option. All right? let's say that the stock moves to $65. We start out our trade. Remember, like in Facebook, I put on the trade, I bought a call, and I bought a put. I bought at the money strike prices, so I was walking right down the center, okay, not hedging either side. Now what happens? Well, let's say that there's great earnings, and indeed the stock moves higher, much higher. It goes from being worth $50 to being worth $65 overnight. Well, look what just happened. Because I had a call option that increased in value, then my delta increased in value as well. And I went from making 50 cents to making 80 cents. Boom, just like that. The put option on the other side, because the stock went against me and went up to 65, remember, put option makes money when it goes down. A put option went against me. I started losing money slower, and now I'm only losing 20 cents for every dollar move of the underlying stock, okay? So when the call option moves my direction, it starts making money a whole lot more than the put option loses. In this case, I got 60-cent net profit in this trade. And that is why a straddle makes so much sense, because of the way the deltas move. Now, let's say that the stock price goes totally the other direction. Earnings are terrible, and the stock falls to the floor. Rather than going up to 65, it falls down to 35. Well, I got the other side of the trade too, because now I'm making 80 cents for every dollar move of the underlying stock, and I'm losing money, but I'm only losing money at 20 cents for every dollar movement of the underlying stock. So my net change in this is, again, 60 cents. And this movement back and forth is the reason why straddle works. Hopefully that makes sense to you. When it comes right down to it, there's two types of straddles. This one is probably the easiest to put on, and it's real simple. One day prior to the company earnings announcements, you just have to go long equal numbers of calls and puts. That's what it comes down to, just numbers of calls and puts. And you want to buy the at the money option, just like we talked about, deltas of 0.50. So puts, delta of 0.50. Now when I say one day prior, here's what I mean. If the company is going to declare earnings that evening, then that means that we're going to trade probably between 3 and 4 o'clock in the afternoon. You know, somewhere before the market close, but later on in the day. So you go long call and long put, equal numbers. So if you buy one call, you buy one put. If you buy 10 calls, you buy 10 puts. You're even money strike prices. Real simple. Then you just sit back and wait for the earnings announcement to happen. One of those options pop. And when I say pop, I want it to pop 10%. That's really the key, because if it doesn't go far enough, it's not going to work out with the probable outcome, okay? Now, here's the second way to set up a straddle. 30 days prior to the company's earnings announcement, you got to go long equal number of calls and puts. The last one, the previous option, no pun intended, option number one, put on the straddle the night before the earnings announcement, okay, or the day of the earnings announcement. Okay, so we're going to back it up a little bit, and we're going to put that straddle on 30 days before the announcement. Then be doing that. Because we're going to purchase 4 months worth of time for this thing to work out, we're going to give the trade a while to set up, 30 days to set up before the earnings announcement, and then we're going to give it, say, 3 months after to let it work its way out. Now, why would you want to put on a straddle a month in advance and not just put it on the day up? That seems to be an equation. Well, here's the thing. This concept is going to allow us to purchase options when the options are considered to be cheap, on sale, inexpensive. So know if an option is cheap or inexpensive. Well, volatility is the measure of volatility is the measure of the price swings of the underlying stock. And if the volatility number is high, then the options premium is going to be expensive. If the volatility number is low, then the options premium is going to be inexpensive, cheap, okay? So there are two types of volatility that you have to compare to one another. This is complicated than it really is. I'm going to show you a graph. You'll just be able to see it right away. But let me explain it here real quick. There's two types of volatility. One's called historic, and one's called implied volatility. volatility is really also called statistical volatility, and it's the measurement of the fluctuation of stock prices over a defined historical period of time. It's just measuring how much a stock flops around on us, okay? Historic volatility is an objective number, and that means that it's derived using a known calculation or solid figures that you can look at and say, okay, that is for sure historic volatility. And keep in mind, it's less important to understand how historic volatility is calculated than it is to see the graph, and I'm going to show you that in a second. The next type of volatility is called implied volatility. And implied volatility is really just an estimate of the volatility of the stock over the life of the option as predicted by the market maker, and that's an important word, predicted. You see, the implied volatility number can react to upcoming news announcements and drug approvals or earnings announcements. It can fluctuate all over the place, but an increase in implied volatility can mean that there's an increase in the option's premium, how much the option is going to cost you. And a decrease in the implied volatility can mean that there's a decline in the option's premium. So implied volatility is subjective in nature because the market maker looks at upcoming events and can pump up that volatility number. He or she can actually increase or decrease the cost of the option just because of what they see coming up in the future. Now, again, it's not that important to figure out how volatility is figured. We just need to know how to understand it when we look at a chart. Now, here's the thing that you need to understand. Implied volatility is a responsibility of the market maker. They are the ones that set that number. And with this ability, he or she has the ability to turn a winning trade into a losing trade or a losing trade into a winner. So the question is that market maker actually a friend or a foe? Some of you have been around the block. You know the answer to this, right? They're not always that friendly. So let's see if we can tell how an option is cheap or expensive. By comparing implied volatility against historic volatility, traders can get a sense of how the option is priced. So if implied volatility is greater than historic volatility, then the option is going to be seen as overpriced or expensive. If the implied volatility is less than historic volatility, then the option is going to be considered underpriced or cheap relative to how it might be trading otherwise. Now here's the beautiful thing. Right here we've got a chart of volatility. You see that kind of yellowish background there? That's actually the option price. And, the stock price. When you look at the red and the blue lines, the red line is the 30-day historic volatility, and the blue line is the implied volatility. So now that we can see right here that on the right-hand side of that chart, the implied volatility line, the blue line, is higher than the historic volatility line, then we know that that option, this IBM option, is really kind of overpriced. It's going to be a little expensive. Now, if we can look at a volatility chart like this and get into our straddles before that happens, we'll be buying the options cheap. And that's kind of what we're after. You see, volatility has a large impact on the strategy. And as the date moves closer to the earnings announcement, volatility is going to increase. That's just the way it is. The market maker sees that an announcement's coming up, they increase that volatility. And the value of the option is going to rise, causing it to be more expensive to buy. Now, buying the straddle prior to the increase in volatility clearly is going to reduce the cost of the trade, and that makes a whole lot of sense to me. You want to buy things when they're cheap, right? And that's the second opportunity for a straddle. You either buy it the night before and pay the additional high price, or you buy it 30 days out before the price is inflated. Now, how do you find straddle opportunities? Pretty simple. There's all sorts of earning calendars out there. This is one from Yahoo Finance, and you can see here that I've got Tesla Motors highlighted there. Because Tesla, you remember this chart, I showed it at the very beginning. I said, who's responsible for making this happen to this chart, and it dropped down? Well, you guys weren't responsible, clearly. It was an earnings announcement that happened. On November 5th, 2013, there was an earnings announcement at the end of the trading day. And right before the end of the trading day, I went ahead and I got into a straddle. And yeah, I know it's a virtual trading account. I hear people go crazy all the time. Oh my gosh, people showing virtual trading accounts. I want to show you my own trading account. I got to tell you, I don't show my neighbor my own trading account. You know what? With all of this stealing of identities, I mean, I don't know enough about that stuff. This is what you get. I'm going to show you how to do this. This is what you're going to get. You're not going to get my real trading account. Sorry about that. Okay, you buy straddle. You buy the call and the put, same strike price, same month that they're going to expire. buy to open on both. There's your order ticket. Get into the trade. What happens the next day? Market falls. Stock falls. Market doesn't fall. Stock falls the day of the announcement. So what happened? Better than expected earnings, but they could not meet the demand due to a shortage of batteries. You know, Tesla, they make electric cars. They couldn't keep up with the number of batteries that they needed to produce, so that drove the stock price down, even though they were doing great. So here's what my straddle looked like the next day. I don't know if you can see this. I think you can. I'm going to use my cursor here. Actually, I'm not going to use my cursor. I'm going to use this little highlight. Right here, you can see that that trade was down $530. Ooh-ah! No, that's not what I wanted, $530. What happened was actually at that point, the market maker had sucked out all the time premium, okay, all the volatility, and my call option was upside down, and my put option was right side up, but my call option was upside down more. Well, let's see what happened at the end of the trading day. The market maker started to stabilize the implied volatility numbers, and what happened? I'm only down $120 at the end of the day. Well, check this out. The next day, I'm not happy about this for Tesla, but they reported another fire, and what happened then? People started running out of the stock. Well, that actually kind of benefited me because my put option was the one that was up, right? Now I'm up $433 or $443. That's the next day. Not bad. Now I'm up $460 as I look at it at 11:45, and then a little bit later on, I notice I'm only up $380. So what I do is, quick like a bunny, run in and check my charts. And I do look at charts to try to figure out my exits. I don't look at charts to get in. I look at my charts to get out. And I saw that there was a support level. I saw there was a Fibonacci level that was hit. And we talk about all this stuff in the Ultimate Options course. But I decided it was time to take a profit, and sure enough, $229 or 6%. Okay, it's not my best trade in the world, all right? But it's better than a sharp stick in the eye, right? 229 bucks, that's all right. One contract trade, I'm all right. How about Netflix? Let's show it again. I showed you what happened with Netflix, and I said, who caused this because you're indecisive? Well, actually, that was an opportunity for Straddle as well because that was actually a earnings announcement. So again, Netflix, get into Netflix, buy the call, buy the put at the same time. Let's see what happened. Got in on January 22nd, bought the call, bought the put, got out on the 23rd on one side, 28th on the other. It's rare that I'll take one leg off at a time, but in this case I did. And what I ended up with $1,629, and that was a 33% profit in 6 days. I'll take it. Most people, 33% profit on their entire account, that's not what I'm saying, but if they found a 33% rate of return, they'd be ecstatic. And that's 6 days with a straddle that I could place based on an earnings announcement. It was an appointment type trade, and you just walk in and do your business and then see what happens. I like that. How about Tesla? Going back to the well again. Tesla, I got a situation where I get in at the $195 call and the $195 put. That's what happens. Tesla moves up $20. That's 11% overnight. Here's what we get. On the 19th, I get in before that earnings announcement, and on the 26th, I'm out. $2,881 worth of profit. That's an 88% rate of return in 7 days. This is my style of trading. That's the way I like to trade. So here's my question for you. You ever feel like somebody's watching over your shoulder while you're trading? Taking stocks the other direction? Are you directionally challenged? Are you the most indecisive person that you know when it comes to trading? Why don't you straddle it? Just wait for the appropriate opportunity based on earnings announcements and then get into the trade. Take both sides. Let it roll. Now, let me tell you, it doesn't work on every single stock, but it works on a handful of stocks that if you're aware of when they have their earnings announcements, you got some pretty good opportunity. And I tell you what, in the next 60 days, I've identified 9 different opportunities, and I'm looking forward to those. So this has been how we make money in the market without picking a direction, and this is my style of trading. Hey, I just want to say thanks. We're going to do another webinar coming up here in not too long. Love everybody to stick around if you could do that. James, are you with us?